Good morning, ladies and gentlemen. My name is June Sedgwick. I work for Savills, and today I'll be giving you sort of an overview on our thoughts on the UK market, but also really focusing down onto the London market. We will be looking at a few hotspots across the UK, but really giving you a sort of update on what's happening in London and in the UK. So London itself, as a prime central market, we've seen a lot of developments entering into Singapore and being marketed most weekends here in Singapore and across Asia Pacific. What we're seeing is that there's more and more people investing in London, and more people investing in what we call prime central London overall. Our transaction levels have exceeded over by 5% since 2007, and in Q1 in 2012, growth was by 2.8%. Areas of prime central London are growing rapidly, and we're seeing key new areas rising and growing. Back in 2007, we saw what we call credit crunch. The market in London had hit its top level, and the credit crunch hit the UK market. What we talk about is London and the UK itself. So the UK residential market took quite a hit. London is its own sort of microclimate, we call, and we look at that as really a separate market from the UK. What happened was, up until 2007, many people in the UK could get financing. Banks were lending between 90 to 100% to first-time buyers. If I went into a bank and sat down with my bank manager and said, "This bank manager, I want to buy a new flat," up until 2007, the bank manager would sit there with me and go, "Why don't we give you a 100% loan? Why don't you need to buy furniture? You need a new car. You need this." Today, if I go in to see the bank today and have that same conversation, they'll probably turn around to me as a UK resident and say, "We're lending probably 50%. So the liquidity in the market dried up, and what we're seeing is more and more international buyers coming in and buying in London. In 2007, we saw low interest rates and making it more affordable to buy, but with no liquidity in the market. The average UK house price versus 5 years ago is 11% lower than normal terms, 24% lower than the real terms as well. Housing transactions dropped by 45% over 5 years. So looking at the UK as an overall here, you can really see that London itself adjusted, probably overall London, Greater London, adjusted itself by 8.9%. The hardest hit areas are probably the north of the UK, which is up here. And what we've seen is places in sort of north UK and across really sort of took a hit. Over the last 2 to 3 years, we've seen prices in these areas sort of adjust themselves and stabilise. But outside of London, it's still not the best market. There are still a few hotspots to look out for, but most areas, north of England and that, have really sort of begun to stabilise, but really did take a hit during the financial crunch. Areas such as sort of southeast and just above London, places like Cambridge, Oxford, where there's key university towns, we're seeing growth, and we are understanding that there's more and more demand. Places like Cambridge, where we've seen big companies like Google, Microsoft, all moving their headquarters or big business centres into the finance parks to increase rental demand in those markets. So it's pushing values up. So we're still seeing outside of London some key locations to focus on, and that really is sort of key university towns, Oxford, Cambridge, and also up in the north area in Scotland, Edinburgh. We've seen brand new big development being brought in there, which is Quarter Mile by Norman Foster. Edinburgh itself is a listed city. It's a protected city, and so we don't normally see new build developments. What's happened there is they put a new build development in the centre of the town, and that's pushed the values up. Demand by the local markets jumped in there, and so the local markets push values up. Our sales forecasts. So Savills, we like to sort of talk about the weather. It's what the British like to talk about every day. It's always rainy. What we have here is sort of in 2013. If we focus on this year, UK itself, as I said, has taken a bit of time. It has stabilised. A year ago, I talked to you about sort of London and the Olympic effect. We were predicting that 2012 would be a quiet year, and in London there'd be no growth. London itself saw over 5% growth last year. This year, it's again a sort of stable year for us. We still believe there's going to be growth, but it's going to be about 1.5%. Where we see the real investment factor and the capital appreciation is really sort of after 2014, when we see the growth really kicking in. And over the next 5 years, sort of outside of London, looking at 11.5% capital appreciation, and in London itself, over 21%. That's London as a whole. If we look down at prime central London, the growth could be up to 25, maybe 30%. And that's really down to less liquidity in the market and also strong demand versus less supply. But London is a huge city with many different areas. You could turn one corner and you're in a different postcode or a different zone. Your price per square foot can change from one street to the next. I think here this really sort of shows you the transactions versus the pre-peak prices and key areas that we really see in growth. Historical prime central London locations such as Kensington and Chelsea, City of Westminster. We've really seen a lot of growth here. A lot of European money has come back into London. You've probably all heard of the term that London's seen as a safe haven. And that's really because a lot of people believe in London as a global city. We've seen a lot of international money, not just from Asia. We've seen it come in from the Middle East. We've seen it come in from Europe, from places like Greece, Italy, Portugal, where people have tried to get their money out because their own economies aren't stable and put it into London, into bricks and mortar, because they see it as a long-term safe haven and strong capital appreciation. So here you can really see some key locations such as Kensington and Westminster, but also we're creating with this market at the moment new locations such as prime South East London, prime South West. Prime South East London was created really due to the Olympic effect. Stratford, just outside, just east of London, is a new location where the Olympic Stadium is. But in there, there's a new rail line, a lot of infrastructure has gone into that. So it's really pushing demand. A lot of the younger generation that would have bought and probably originally lived sort of Kensington, Chelsea, West Fulham, those sort of locations are being moved up to east, where there's new homes, new shopping malls, new transport links. So we're seeing a strong demand where people want to be in those locations because it's easy to get into Canary Wharf, the City of London. Average values, high trends. So here on this slide, really, if you look at these sort of the green areas that are highlighted, it really shows you where the values and the focus of investors have come in. So it's creating new locations, as we say. So this is central London here. You're seeing sort of growth down here, which is what we call, it's really now what we call prime southwest London. And what you historically are finding is buyers who would have bought in Chelsea, South Kensington, have been outpriced at the market. They're looking to buy family homes and they can't afford to buy them. So they're moving south of the river, moving down to areas such as Richmond-on-Thames, Putney, all of those sort of locations where there's bigger family homes and the market's growing. As I mentioned before as well, sort of East London here, Stratford, new connectivity. There's a lot happening there. So there's a lot with the Olympic Stadium, with the Crossrail going in. It's all about finding the right sort of locations. Exchange rates. A lot of us have all sort of been watching the pound over the last week and seen it sort of take a rather large tumble with London losing its AAA grading. What we found is if you look back to sort of 2007, where we were, when you bought a property in London, if I was in Singapore and I had 300,000 Singapore dollars, I'd go and buy my property. Property was on the market for £300,000. I'd go with my Sing dollars, that would cost me 900,000. Today, if I go and buy the same property for £300,000, it's only costing me 600 to 590,000 Sing. So I've already made a saving on the exchange rate. And that's what a lot of our investors are looking to do. And we're seeing that. In time, I can't predict it. I can't say to you, yes, the pound is going to come back strong. But it is our belief that the pound one day will come back, and that there is a very strong exchange rate play there, where a lot of investors will make money. As I said, and then looking sort of at London as well, sort of the new build sector. I mentioned that London's seen as a safe haven. We've seen a lot of international money, and this slide really highlights the sort of number of different countries, different parts of the world that are looking at the UK to invest in. If we look at the second-hand sales for the first half of 2012, 19.7% was made up of just European and Nordic, 10%, 16%, was made up of Western European and Nordic money coming into the market. In the new build sector itself, only 23% of the UK were investors. Asia made a big part of that, and we're seeing more and more money being international buyers. Capital values, where have they gone since sort of the Q3 credit crunch of 2007? I mentioned to you earlier sort of these new sort of southwest locations, prime southeast up here, and also sort of north, Islington and Hampstead. Since 2007, these locations have seen phenomenal growth. Wapping, Canary Wharf, East London, up to 6%. Prime southwest London, where a lot of the UK, where a lot of the London families are moving to, but also we're seeing more and more investors buy into the area with the new connectivity. A lot of people ask us why this is happening. I think the key factor is also to look at where new connectivity is going in. A lot of you have probably heard of Crossrail going in by 2017 in and across London. Basically, Crossrail will start sort of right down near Woking and come through the centre of London and out through Canary Wharf and out east. It will mean that Canary Wharf to Heathrow, you'll be able to connect directly in less than 15 minutes. This hasn't been heard of before in London, and it really will open up London. And that's where a lot of investors are looking at the new Crossrail stations and key places as investment. We saw a massive growth around Tottenham Court and a lot of interest around Tottenham Court, which is just in the heart of London, just up here, because of the new station that's going in there. So growth is continuing in London, and capital values are rising. In 2012, we sort of predicted with the Olympics that there would be some growth. Back in 2008, we said there would probably be about 11% growth. The Euro financial crisis happened, and in October 2 years ago, we reviewed our figures and said, we think it would be 0%. By Q1, growth had already happened. We saw 2.8, nearly 3% growth. So London is pushing. By the end of last year, by the end of 2012, we saw at least 5% growth in the market. Global economy and sentiment, where we are with GDP forecasts. The UK is fighting back, and we can see this over here, between sort of the US and the Eurozone, but the biggest GDP growths are coming from India, Asia, and the rest of the world. But what we see and what we understand is that London still is a global financial centre. It's one of the places in the world where in the morning you can talk to Asia, and by close of business you're talking to the US. The world still see London as that global financial centre, and really there are only sort of two key global financial centres. That's New York and London, and that's where a lot of investors are seeing their money and putting their money into, as it's seen as a safe haven, and it will continue to support that. We prospect. So we talk about the rental market. The growth of city jobs in London has been, in 2000 was probably at a record high. It has sort of taken a dip and increase, and probably will steady out over the next 5 years. But the city will continue to grow, and we will see that, but it's not going to be as big as what we've seen in the past. What we're seeing is, even with the city jobs declining, we're still seeing the rental market very strong. There's strong demand because people can't get liquidity in the market to get their financing, to get mortgages, so that they have to rent, and they have to go into the rental sector. So what will happen with the rental market with changes in jobs? You can see here really sort of the key line here shows you the way the rental market's gone in London. And then the movements. Prime London rents, it's a bit of a roller coaster. But growth will continue, and it does bounce back. As I mentioned, a lot of people move to London, and with the whole of the UK economy at the moment, we're seeing more and more of the younger generation who graduate from university, who would have probably found a job up north historically, or stayed near their hometowns, moving more towards London because that's where the opportunities are. The rest of the UK is still recovering, but London is still booming, and still trying to push the business out there. So a lot of people from all over the UK are moving into London to get work and work in the city or across London. This is pushing the rents up. They can't afford to buy, so they have to rent. There isn't enough supply, there's more demand. So it's actually keeping the rents increased every year. Last year we saw at least a 7% growth in rentals over 12 months. And this year we predict again probably another 7 to 8%. I mentioned to you the sort of stretched deposit affordability, and it really is that banks to UK residents aren't lending. Financing options out here in like Singapore are available for international buyers, and on average you're borrowing about 70% loan to value on and you can borrow in Singapore dollars. In the UK it's very different. If I'm a 30-year-old going to the bank manager for my first property, I'm probably having to put at least 50% down before they will grant me a mortgage. A lot of first-time buyers are having to go to what we call bank of mum and dad to get that support, to really get on the property ladder. If they can't get in the property ladder, they are forced to rent, and that's a good thing for investors because it again pushes the rental market. But on a positive note, banks are beginning to open up the their loan books again, and we're seeing more banks beginning to let people borrow again. But it's not at the levels that we saw back in 2007. Rental forecasts. Again, we go back to our sort of weather report for you. And as I said, prime central London and greater London, we're going to see at least a 3% growth over this year. And this is sort of Savills being very conservative. I gave the same sort of predictions for last year, and as I said to you before, we saw at least 7% come out of London last year. So at the moment we're predicting about 3% growth. By 2014, over the next 5 years, if you buy in prime central London, for example, you're looking at 24% rental growth. If you're buying UK mainstream, so that's outside of London in places like Oxford, Cambridge, even up north, you're looking at least an 18.2% rental. And that's really, until the banks start lending, that's pushing the rental market. A lot of people ask me in a lot of the exhibitions that we do, are there too many overseas buyers renting and buying? And what are they doing? Is there going to be an oversupply of rentals? But I think this slide it gives you some quite interesting facts. I think the key point, across prime London as a whole, 66% of the international buyers are actually buying for their own residence. They're not buying for investment. They're buying it as a residence for themselves. So it proves that there is, a lot of the properties that are being bought aren't just being bought for rental, they're actually being bought as a primary residence or a residence for the owners. We have a lot of investors buying for the children, for education, and where they're putting it on the market for rental, but then it's a long-term view. With London, and if it's investing in London, our view is very much, it's not a jump into the market, buy today, and sell your property in a year's time and make some money. Those days of sort of flipping properties in London aren't really there anymore. It is very much a 3 to 5 year investment plan and focus. So you're looking at the minimum, my personal advice would be to buy and sit and hold for a property for at least a minimum of 5 years in London to really appreciate the capital appreciation and also make on the rental gains as well. Mortgage rationing. So here we really are, as I mentioned to you, the imposition of very low loan-to-value ratios. It's really the banks controlling the market. Lending has fallen by 95% since the summer of 2007, and the average deposit has doubled for first-time buyers. Buying London properties. What are your costs incurred? I think the key thing about London, it is an international city. We welcome people, we welcome investors, we want international buyers to buy in London, and we really want people to put their money into London. So the UK at the moment are trying to make it as easy as possible. I think that the key thing, the one-time cost to you as an investor, is your stamp duty, legal fees, and then your disbursements. Your annual sort of costs that you're going to be paying out every year are your typical sort of service charge for a new build. The ground rent. Ground rent is very much a historical rent, and that's paid to your freeholder. And it's normally on average £300 to £400, depending, and doesn't increase very often. It will increase probably every 30 years. But it's basically, it dates back to medieval times where the farmers were paid the privilege for using the land, and so that rent has stayed. Leasing and management fees. A lot of people buy properties for investment. You do need an international agent to rent, to manage your property. A lot of agents will offer full service, such as Savills, where we will collect your keys, we will check the property for you, we'll lease it, we'll sell it, we'll do whatever you want. And on average, with London, your average management fees vary from 12.5% up to 17%, depending on the agent. And then income tax rental, but this is pretty much your only tax that you are paid while holding a property. We have no property tax in the UK. You do, however, pay income rental tax. But the key thing about this is it is purely on the profit of the property, of your rental income. So once you've taken off all your costs, such as your interest on your mortgage, your service charges, your ground rent, your leasing management fee, even if you flew over to the UK to go and inspect your property, that is tax deductible, that flight. All those, once that comes off, you then pay the tax on the profit, whatever's left over. So stamp duty. As a lot of you may know, that the government in last year's budget sort of increased the stamp duty really to not attack, but bring it, control sort of the prime central London market and then the bigger investors. It was a bit of a cooling off measure for London. So anything over 2 million, as of March 2012, the stamp duty went up to 7%. But if your average investment property in London is going to cost you sort of between the sort of £500,000 to £1 million marks, you are looking at about 4%. Stamp duty is paid on completion, and again in the UK we do not charge stamp duties when you come to sell the property. It is only a one-time cost of when you come to complete the property itself. What happens with the budget in April this year, we don't know, but most of our research is saying that the stamp duty will stay as it is. We don't think they will increase it any further. With the sort of mansion tax of over 2 million, they have sort of controlled that market now, and the government, the key, what we're seeing is the international market is the market that's keeping the London market going. So the government really wants to keep that, keep the money coming in, rather than sort of stopping international buyers. Income tax, so I mentioned to you before sort of the income tax, and this is really on your rental income. So you basically, for most investors, as long as you've got 1 or 2 investment properties, you're probably looking at paying about 20% on your profit, unless you really go any higher. Because by the time you've deducted your costs, you have our advice is very much to instruct an accountant to do your tax return in January for you. And if you have a good accountant, they will work every cost off for you. So by the time you come to paying tax, it should be very low, and it's normally below the 20% mark. Why invest in London? As I sort of touched on a few key points for you, really. But it really is that London is an international, global city. We're investment oriented. We want investors to come into the market. We understand international buyers. So it's ease of entry and exit. Compared to other countries, we don't charge any capital gains tax to foreigners. So when you come to sell the property, if you've made £200,000 on profit on selling that property, you can walk out the country with that and you are not taxed. Rising demand. We've seen a lot of demand in London. And the key issue that we have in London in particular is that there is not enough supply coming into the market. During the credit crunch in 2007, we saw a lot of the house builders stop building. And the government was about 250,000 houses short a year of its quota, and that's continued. So there's not enough new build product coming in, new build homes for the amount of demand. So that's pushing the demand up and pushing the values up. London is seen as a safe haven. As I've mentioned to you before, global international markets are jumping into London because they see it as a safe haven. A lot of people are investing from the Middle East, from Europe, from Italy, Greece, and even from Asia, because they see it as a safe haven. We're politically, business and legal, financials, all of our systems are in place to welcome international buyers. And also, our education is a key factor. We have some of the best universities across London, and also in the UK. And ease of financing, buying local banks here in Singapore. What we found is a lot of the local banks here are offering Singapore dollar loans or sterling loans on Singapore interest rates. So you're not paying the high rates in the UK, but you're paying Singapore interest rates, which is a benefit and a rather large saving. Thank you very much.